When the owners of UFirst Financial created the Money Merge account 5 years ago, little did they know they'd have such a positive problem on their hands now. You see, many of their clients have come to them and said, now that we've become completely debt-free, including our mortgage, now what do we do? In doing so, they created a sister company called UFirst Alliance. And now we can provide a full-circle financial solution for people. And this step we call the banker's table or the Wall Street alternative. You'll also hear it referred to as BOSS, Banker's Optimal System of Security. Now we can help people eliminate debt, build wealth, plan for retirement, and leave a legacy for their families. The reason we call this the Wall Street alternative is because we do not believe in risking the principal value of your investment. How many of you have lost 20, 30, even 40% of your 401k and are now wondering what you're going to do for retirement? We believe so wholeheartedly in this rule that rule number 2 is never violate rule number 1. And rule number 3 is we believe you should have guaranteed returns. No more guessing. We wanted to take a look at what the banks were doing and emulate that. So what do the banks do? Well, first of all, they have a lot of cash on hand. Second of all, they do not risk their investments. They invest in secure things like treasury bills and precious metals. And look what gold is doing right now. And the fourth thing may surprise you. They actually invest in whole life insurance. It's called bank-owned life insurance. They actually take out whole life policies on their key employees, and then they bank with these policies, meaning that they put money in and they pull money out, and they always pay themselves back with interest. What this does is it grows that value of that policy much more rapidly than if they did not do that. A little known fact is some major corporations like Walmart, for example, has over 330,000 of these bank-owned life insurance policies on their, or they call them corporate-owned life insurance policies, on their employees. And that is one reason why they're doing so well. What do most of us do when we need to buy a car? Well, we go down to the bank and we get a car loan, and then we pay it back with payments and interest, all the while paying out a large amount of money that it is never going to be recaptured. This is money that you pay to the bank that you will never, ever see again. And you may have the car, you may not have the car, but you will never see that money again. Here's our strategy to accomplish that. Set up your own policy and pay into that policy, either monthly or in lump sums, in a period of 4 to 7 years. When you need to buy the car, you can borrow that money from yourself and pay cash for the car, which gives you a better bargaining standpoint. And then you pay yourself back with interest. That's the key. And what you do then is you recapture all of that money that comes back to you, and it remains in your policy while it is compounding interest upon itself. So even if you don't have the cars to show for it at the end, you've at least captured this money for yourself. Look at how this banking concept would apply to financing automobiles over a 40-year span of life. Let's say that every 4 years we purchased a $25,000 car, equaling 10 cars over that same 40 years. Now we know that not everyone would do that, but we're going to use it for this example. Let's say that you lease those vehicles first, paying back to the bank with interest. That would potentially be $252,000. Now you didn't have the equity in those vehicles when you turned them in, so if you financed them, you would pay a little more per month in payment, but you would have the equity in those vehicles when you turned them in, so you would pay a little less in the long run. Now let's say that you paid cash. Everyone always thinks cash is king, but you would have to pull that cash out of a potentially interest-bearing account to do it. So you wouldn't have the benefit of earning that interest with that money, but you also wouldn't have to pay interest to the bank. So it ends up being a little bit better. If you were to do it our way, you could potentially have $552,000 that has grown inside this policy over the course of that same 40-year period. And this is because of interest compounding on itself. Now bear in mind, everyone is different, and depending on the age and the health of the person when they start this policy, this could be a higher number or a lower number. We kind of picked a middle of the road number here. And also bear in mind that if the person doing this policy is older and or of ill health, they can put this policy on anyone, their child or their grandchild, or anyone the life insurance company would consider them having an interest in. Now also realize that this money is growing tax deferred. You don't pay interest on cash value while it's growing. You're also growing the death benefit at the same time. When you borrow from this at retirement, you borrow from the death benefit, reducing what would go to your heirs when you pass on, but when you borrow from the death benefit, it is tax-free. So you are creating a potentially tax-free retirement for yourself. What else can you say that about? Can you say that about your 401k? Can you say that about your real estate investments? How about your stock investments? And all the while, this money is also growing at a guaranteed rate of return. Let's take a look at retirement planning with BOSS, or Banker's Optimal System of Security. The flexibility includes not limiting you to being 59 and a half to pulling your money out like a 401k does, or requiring you to pull it out when you're 70 and a half like a 401k does. It provides a tax advantage because when you pull the money out, you're borrowing against the death benefit, which is tax-free. The tax-free estate death benefit also is created because when you pass on, you pass that money to your heirs as a tax-free death benefit. The living benefits, which are even more exciting, include a loan provision. You borrow from yourself to buy automobiles and such. You pay yourself back and you grow the fund. The emergency fund, what happens when you have life's little emergencies that happen? You have a place to pull that money from. You have retirement income. You have personal financing needs. You can even fund a business through this. All of these are potential options. Begin your road to financial freedom today. It only takes a few minutes to give us the information we need to run the free, no obligation analysis, and it really is fun to see what this program can do for you. Please let us help you get started.